All right, I believe we're at an important juncture. So there are two types of traders. There are trend followers, and then there are regression to the mean traders. So retail, hedge funds, these kind of people tend to be trend followers. Generally speaking, they will catch on to a trend, usually kind of late in the trend. Retail traders especially are they haven't learned how to control emotion, so they tend to buy at tops and they tend to sell at bottoms, the exact opposite of what they should do. And then they get caught when the major trend reverses and they lose money. So they're instead of buying low and selling high, they're doing the exact opposite. They sell low and they buy high. Smart money, the bank trading desks, the people that really know what they're doing tend to be regression traders. So the further price stretches away from the mean, either up or down, the more nervous these type of traders become. And the SMT employs kind of a combination of both. We like to trade the trend, but we also want to try and get in at the bottom. And that's what cycles and sentiment, the two tools that I use primarily to trade the markets, those two tools are pretty good at getting us in pretty close to the bottom. So we do try and ride a trend, but we try not to buy at tops. We try and buy at the bottom when everybody else is afraid, and when the narrative is that price can, for whatever fundamental reason they imagine, price can never turn and go back up. We saw this in spades at the bottom at the end of February in metals. But unlike the typical retail trader, I don't tend to get more and more bullish as price continues to go up. I get more nervous. So I like to look at the long-term charts, and when I see a chart where price is stretched too far above the long-term mean, and this here is a weekly chart, and this is the weekly 200-week moving average, I get nervous. And the further it stretches, the more nervous I get. And you can see from past experience here, every time price gets stretched too far above the mean, you'll get some kind of a corrective move that'll will regress back to, and very often, depending on how far it stretches to the upside, it'll go back below the mean. So while I'm seeing lots of people, guaranteeing that stocks still have a long ways to go, which I probably think they do in the longer run, but right now it is becoming dangerous. You can see here the weekly MACD is getting ready to roll over. I'll show the Dow here in a minute. It has rolled over in the Dow. And then here's another characteristic. When a cycle right translates to an extreme degree, you generally get some kind of a crash event. And the reason that happens is the cycle is just running out of time to correct. And so it has to compress the correction into a very short period. So you get a crash. And that's what happened back here in 2020. The 4-year cycle low came in 2016. One could make a weak case that maybe this was the 4-year cycle low, but it was a little bit too early. So I was under the impression that we still had a deeper move down that would qualify as the 4-year cycle low. And sure enough, we get the world loses its mind and we lock down everything for COVID, and we create a recession when there was no need for a recession. And then we get this 3 or 4 week crash into the 4-year cycle low. And so you can see how that unfolded. The cycle right translated. It kept going up and kept going up and up and up and up, and it kept pushing deeper and deeper and deeper into that 4-year cycle to finally the point at which there just wasn't any any time left in that 4-year cycle, so it had to compress the entire move down into the 4-year cycle low into a very short period of time, so you end up with a crash. I think we're doing the same thing here. Again, you could make a weak case that maybe this was a very short 4-year cycle low, but again, it's coming way too early, in my opinion, for this to be the 4-year cycle low. So I suspect that it's probably going to unfold here very quickly over the next 3 to 4 to 5 weeks, and probably as another crash event. I really, there's a couple of things that could trigger this. If we get a collapse in the bond market, confidence in bonds, just nobody wants to buy U.S. bonds, and we get a crash in the bond market, that might trigger it. Also, the wars in Ukraine and the Middle East could intensify, and if we get some kind of a major attack on a major city, something like that, something that indicates that the war is about to expand and get much worse, that could maybe trigger this. But I think we are on the precipice here, and these runaway moves, this is usually how they end. They will end in some kind of crash event, simply because you had so much dumb money chasing late in this runaway move. So you just got lots and lots of stops all along here, and as they start to trigger, then the selling intensifies until you just get this panic move and everybody just dumps. And so I suspect that's probably what we've got brewing here over the next 3 to 4 weeks. Let me just show you the Dow really quickly. So you can see here in the Dow, again, you got this really stretched move up, and you can see the MACD, the weekly MACD is already rolled over. So the process has already begun. And when you get these crash events, you'll get massive margin calls, and people will dump everything. So I don't think you're going to be safe in precious metals, or probably not energy either. The people, funds they're going to sell everything to meet margin calls, and metals are also in a bit of a precarious position in that they've also gotten stretched a long ways. We had a vertical move, and again, as usual, the narrative, the traders manufacture a narrative to explain why price is doing what it's doing. I think this time the narrative was that the East was buying, and of course that meant that gold and silver could never go down. The exact opposite of the narrative that we were seeing here. Everybody was convinced that gold could never go up, and of course silver and miners were getting hit really hard right here. Gold, not so much. Gold is mostly just going sideways. But I think there's probably a very good chance that gold's going to come back down and retest this breakout during this panic selling period that I think we've got coming ahead of us here. So generally, I only open the SMT at bottoms because I want people I want to force people to buy at bottoms, not chase at tops. And this is what usually happens. I've had tons and tons of requests to join the SMT, but they're wanting to join at the top because they're wanting to chase, and I won't allow people to do that. But I may make an exception here. I may open the SMT for one day, Saturday here, so people can get in and then look at the analysis for the weekend report and hopefully make a decision to sidestep and get out of the way of what I think is probably going to be a rather severe selling event over the next 3 or 4 weeks, 5 weeks, something like that. And it probably will. It should infect everything, including precious metals, and again, maybe energy. So I'll open the SMT for 1 week, and this is not so that you can buy and chase a move in stocks or in oil or in gold. It's to warn you that I think you probably need to be taking profits in these markets. And if you got caught at the top here, I'm going to tell you, you're better off to sell now while your losses are small than to ride this all the way down, because that's going to be a rather large loss to come all the way back down and retest this breakout here at 2090. So you're better off selling now for a small loss than to finally panic out down here at the bottom. So I'll open the S&T for 1 day on Saturday for anybody that wants to. In this case, instead of trying to force you to buy low, I want to give you the opportunity to sell high and not get caught in what's probably going to be a pretty severe correction in everything.